If you own rental properties and a lender has told you that you've hit your limit, that your debt to income ratio is maxed out and you can't qualify for another loan, there is a loan type that never looks at your personal income at all. Not your W-2, not your tax returns, not your existing mortgage payments stacked against your salary, none of it. The loan qualifies based on one thing only, whether the property pays for itself or not. Here's what nobody tells landlords who are trying to scale. Conventional loans are designed for people buying homes to live in. The entire qualification framework, income, debt to income ratios, debt load, is built around a homeowner, not an investor. When you try to use that framework to build a rental portfolio, you hit a ceiling fast. Every property you add makes the next one harder to get. You get penalized for your own success. DSCR loans work differently, and most investors who are stuck at 2, 3, or 4 units have never been told this option exists. Stay with me through this video. At the end, I'm going to show you the exact calculation lenders use to determine if a property qualifies, and you'll be able to run it for yourself on any deal you're looking at right now. In this video, I'm going to show you exactly how DSCR loans work, how the qualifying math is calculated, and how to know before you ever talk to a lender whether a property would pass, using the same framework I walk investors through regularly. The DTI ceiling problem. Here's what I hear from landlords all the time. I own 3 rentals. I want to buy more, but my lender said my debt to income is maxed out and I can't qualify for another conventional loan. This is one of the most frustrating spots an investor can land in. Because on paper, your portfolio is working, the properties are rented, the cash flow is positive, you've done everything right, and the bank is still telling you no. Here's why that happens, and why it's a problem with the loan type, not with you. A conventional loan counts every debt you carry against your personal income. That includes the mortgages on your rental properties. So if you have 3 rentals with $1,200 monthly payments each, that's $3,600 a month being counted against your debt to income, even if the tenants are covering every dollar of it. On a $90,000 salary, your gross monthly income is $7,500. If your personal debts plus your rental mortgages push your total monthly obligations past $3,375, which is 45% of $7,500 income, most conventional lenders say no. You're not broke. You're not over-leveraged. You're in a framework that wasn't designed for what you're doing. DSCR loans remove your personal income from that equation entirely. The lender doesn't ask what you earn. They ask one question: does this property's rent cover its own mortgage payment? So how does the math actually work? Let me show you the exact calculation. How DSCR is calculated. I've heard of DSCR, but I don't know what the number means or whether my deals would actually pass. DSCR stands for Debt Service Coverage Ratio. The formula is simple. Take the property's gross monthly rent and divide it by the total monthly debt service on that property. Debt service is the full PITIA payment. That's principal, interest, taxes, insurance, and if there's an HOA, you got to count that too. Not just the mortgage, the full number. So if a property rents for $1,800 a month and the PITIA payment is $1,400 a month, the DSCR is 1.28. $1,800 divided by $1,400 is 1.28. Here's what that number means. A DSCR above 1.0 means the rent covers the mortgage. The property pays for itself. A DSCR of exactly 1.0 means that rent equals the payment. Break even, no cushion. A DSCR below 1.0 means the rent doesn't cover the mortgage. Most lenders won't touch it, but some will. I can help you find those. Most DSCR lenders want to see a minimum ratio somewhere between 1.0 and 1.25. Depending on their program, a 1.25 means the property generates 25% more income than it needs to cover the debt. That cushion gives the lender confidence that a vacancy or a rate fluctuation won't sink the loan. Here's the part that gives you control before you ever make an offer. You can run this number yourself. You need 4 inputs: the expected monthly rent, the purchase price, the estimated interest rate, and the property taxes and insurance for that market. Run the PITIA on your calculator. Divide rent by that number. If it's above 1.25, you're in strong territory. Between 1.0 and 1.25, you may qualify with some lenders at a higher rate. Below 1%, the property doesn't service its own debt and DSCR financing gets difficult. Not impossible, but difficult. That number tells you whether a deal is financeable before you spend $1 on due diligence. Now, let me show you what this actually looks like for a real investor. This sounds good in theory, but I want to know what it actually looks like for someone in my situation. I worked with an investor named David not long ago. He's an engineer, solid W-2 income, owned 3 single-family rentals in the Raleigh area. All 3 were cash flowing. He was doing everything right. He had a 4th property under contract, called his lender, and the lender ran his numbers and told him his debt ratios were just over 50%. That's too high for another conventional loan. Deal was basically dead. He came to me thinking the portfolio was stuck at 3 doors. First thing I did was run the DSCR on the property he had under contract. The market rent was $1,950 a month. We estimated the full PITA around $1,480. The DSCR came to 1.32, well above the threshold. Property services its own debt with room to spare. His W-2 income never came up once in underwriting. His existing rental mortgages never came up. His debt to income was completely irrelevant to this loan. He closed on that property and he's already looking at a 5th. Here are the 4 numbers every investor needs before calling a lender about a DSCR. Number 1, the expected monthly rent. Use comparable rents in the area, not wishful thinking. Lenders will pull their own rent comps, and if your number's inflated, it'll come out to hurt you. Number 2, the full PITI on the target property. You want that whole payment. Get the real rate quote, pull the actual tax records, and get an insurance estimate for that particular property. This is the denominator in your calculation. Guessing it wrong changes everything. Number 3, your DSCR. Divide the rent by the PITIA, write the number down. Anything above 1.25 is a strong file. Anything above 1.25 is a strong file. Anything above 1.0 is worth a conversation. Number 4, your down payment. Most DSCR lenders require 20 to 25% down. This isn't a low down payment product. It is a no income verification product. Those are different things. Make sure your capital position fits before you run the analysis. DSCR doesn't care how many properties you already own or what your tax return says. It cares about one thing and one thing only. Does this property pay for itself? Quick pause right here for a second. If you're already pulling up a property, you're thinking about running some numbers, checking this math in your head, that's good. That's exactly what this is for. Hit subscribe so you don't miss the next video, and drop how many doors you currently own in the comments. I'm really curious to hear what the people watching this video have in their portfolio right now. Let me bring this all together. 3 things you know now that most landlords trying to scale don't. 1, conventional loans penalize investors for owning rentals. Every property you add counts against your personal debt-to-income ratio, even when tenants are covering the payments. That's a framework problem, not a you problem. 2, DSCR loans underwrite the property, not the person. Your W-2, your tax returns, your personal debt load, none of it enters the equation. The only question is whether the rent covers the mortgage. 3, you can run the DSCR yourself before you ever call a lender. Rent divided by PITIA above 1.25 is strong. Above 1.0 is a conversation. Below 1.0 may be a pass, but if it's close, let's talk about it. Here's the calculation I promised at the start. Take the monthly rent on any property you're evaluating, divide it by the full PITIA, principal, interest, taxes, insurance, and HOA, That number is your DSCR. Run it right now on whatever deal is sitting in your pipeline. If it comes back above 1.25, you have a financeable property regardless of what your personal DTI looks like. At the start of this video, I told you there's a loan that never looks at your personal income. Now you know exactly how it works, how the number is calculated, and how to know before you make any offer whether a deal qualifies. The DTI ceiling your lender told you about for DSCR loans, it just doesn't exist. If you're watching this with a specific property in mind or a portfolio you're trying to grow past where conventional loans will take you, that's exactly the conversation I want to have. My name is Michael Martin. I'm a licensed loan officer based in Raleigh, North Carolina. I've been doing this since 2002, and I have over 1,200 five-star reviews from investors and buyers who came to me after hitting these walls. I work with investors regularly on DSCR loans. I know which lenders have the best terms right now, what thresholds they're willing to work with, and how to structure a deal to give it the best chance at closing. Click the link in the description and book a free call. We'll look at whatever you're working on, a specific property, a portfolio you want to grow, a deal that got denied somewhere else, and I'll tell you straight whether the DSCR financing makes sense and what it would look like. Subscribe if you're not ready for the call yet. There's more coming. I'll see you in the next one.